The Fed kicks off its two-day meeting ahead of Wednesday's rate decision. Policymakers are widely expected to be steady, but the odds of a hike have climbed to about 1 in 3, 33%, up from just 16% a week ago. Joining us now, Fundstrat's head of research, Tom Lee. He's also the chairman of BitMine and a CNBC contributor. Tom, welcome. Would you take that prediction market bet, so to speak? What do you think? Is there any real chance the Fed hikes rates this week?
I think that, the prediction markets and funds want to hedge on a binary event. That's why you got the 30%, because someone needs to hedge something. But I'd say the probability is low. I mean, I wouldn't expect them to raise rates.
What about at any point in the future?
As you know, they're going to see how the data unfolds. So I don't think it's data dependence, but data responsiveness. To us, I think the underlying inflation story has really weakened because shelter is really weak, and we'll see it tomorrow with Case-Shiller. And if wages aren't pressure, then the real pipeline of underlying inflation that we're seeing now is just tariffs and oil, which aren't things the Fed has to necessarily embark on a hiking cycle for.
Potentially, I don't want to use the bad word of transitory. They're potentially temporary, right?
Yes. And
oil is down right now because there's some talks. And by the way, tomorrow could be up again. We have no idea what's going to happen. Depends on the talks. But the point is, if and when there is lasting sort of peace, oil will likely go back down. The market seems to want to push it back down. That's got to impact the Fed's thinking.
Yeah, because then they just have to see this little bubble that they have to kind of manage through. I mean, I think in some ways they might just shrink the balance sheet instead of doing a policy rate change.
A quantitative tightening?
Correct. Yeah, I think that's a better way to titrate. What they might say is like, hey, let's try to put some pressure on growth, but not to deliberately slow the economy.
Is that any kind of thing that can really upset the stock market?
The stock market's going to ultimately see the idea that, hey, the Fed shrinks the balance sheet, and then that means they can cut rates. And so then they'll see the rate cuts as actually positive. So I think it's going to pave the way for future rate cuts, actually.
So if the Fed is not the number one most important thing for the equity markets right now, what is?
Well, I think that the AI trade remains still the most important story, and people, of course, are having longevity doubts. But, if someone goes back to 94 to 2000, there were many times when the internet story and even stocks like Cisco came under question whether there was durability. And I think we're in that questioning its durability at this moment. But I think it's still in very good shape. And I think the second big story out there is that margin debt still needs to work off that high level of growth, just like what happened in Korea, which had a sort of a margin call. And I think that's why stocks are stalling here. But to me, I think AI still works strongly through year end.
Perfect segue. We had this morning, Steve Eisman was on Squawk Box this morning, the famed investor. Here's what he had to say when he was asked the major question of the earnings season, which is what happens if big tech starts cutting its AI capex.
Nvidia, I think when they reported last quarter, had 85% revenue growth. So if the hyperscalers cut, it wouldn't be 85%. And, maybe that would be healthy for the long term. But I think the market would go straight down on that news.
Just curious for your thoughts, reaction to that. And whether you think that's even likely or worth discussing at this point versus what Google did, which was raise and still get punished.
Yeah. Well, so on the one level, I'd say I think Steve's logic, there's some logic to it. But the fact that many people are saying that is a sign that we're not at a top because people are questioning the longevity of the cycle. So I think that's actually a bullish thing. The second is it probable? I'd be doubtful that there would be the cuts because, these companies still have access to the bond market, and the bond market isn't denying them capital. So, as you know, CFOs raise money when they can, not when they need to. So I think the spending visibility is going to be very strong.